It's Brian Preston, the Money Guy.
And let's talk about how do you protect yourself from this? Because I think it is important to kind of figure out, are there some investments, are there places you can put your money that will actually let your dollars, go a little bit further? Because that is the concern. You're worried about if you're just sitting on cash, if a jar of baby food is $1, and then you fast forward. I don't know. You know what?
I know exactly why
we
you
had a
thought
baby
that.
shower yesterday here in the office, so that's
how we know it's
front and
$1.
center. So I'm off script here, but it is one of those things. If all of a sudden, now a jar of baby food was $3, you can see how the purchasing power of your single dollar that's in your pocket has diminished greatly. So you have to worry about that. How do you protect yourself so that you're not losing on the purchasing power of the assets you have, but also getting some appreciation that's hopefully keeping pace with what's going on with the loss of purchasing power?
Yeah, one of the financial products that we've talked about recently that's been super sort of a hot topic is I-bonds, right? I-bonds came around. They were first issued in 1998, and they were designed to keep up with inflation. You were supposed to get a fixed rate of interest plus an adjustment for inflation to help combat some of that. And so as we sit here today, hearing about what I-bonds are returning, something like 7%, we immediately start thinking, oh man, are these things that I should be taking advantage of? Is this, in fact, the best way to combat inflation? And Daniel pulled this chart for us from 1999 through 2021. It shows what the composite I-bond rate was, so the fixed rate of interest plus the inflation adjustment relative to what inflation was. And as me and you were talking about this pre-show, Brian, you had some sort of, it was sort of a unique thing you noticed. You're like, okay, man, that doesn't look the same now as it maybe once did.
Well, if you go to the Treasury website, now look, government moves a little slower, but they'd stated their original intent with these I-bonds was it was going to protect you from inflation, plus get you a little return on top. And that seemed to be the narrative as well as what the practice was. 98 is when these things came on the scene. So you see all the way through, and then about something happened, 2008, it's like we had the big financial crisis, and they're like, that whole extra on top of inflation?
We're not doing that
Let's
anymore.
hope they forget that part of it, because you can quickly see that I-bonds have not tried to beat inflation. They basically are just inflation.
Keeping up with inflation.
If you see the chart, it does definitely show that these things are right in line. There's not really much of a premium that is paid, and that's something to keep an eye on. We did a show on this, Bo, not too long ago, that if you want to go deeper into it, I will tell you off the cuff, though, I like I-bonds, but there are some huge limitations in the fact that you have to buy them directly through the Treasury. You can only do so much a year. I believe it's $10,000 per individual, and then $5,000 through a tax return on top of it if you want to get a refund from that. So it might not be perfect just because it's not something you can slap into your IRA your brokerage account. You have to actually go buy this thing directly from the government. But go check out our deep dive on this, and it will definitely give you all the data you need to know.
So if I-bonds aren't the solution, or they're not maybe the large solution that you need, we want to talk about some things that realistically can help protect you from inflation. And I would say, Brian, this is probably one of our favorites. This is the one that we talk about the most, and this is the one I think that probably has the highest likelihood to keep people protected over the long term when it comes to fighting inflation. And that's stocks, investing in companies and businesses.
Yeah, I mean, we could have titled this equities too, because we're using, a lot of times mutual funds and ETFs because they're investing in these things. And this is one when I'm watching Twitter feeds and other things, I kind of pull my hair out a little bit in the fact that, because people are always talking about, of course, real estate. They're always talking about, truthfully, you don't even hear about I-bonds that much.
No,
we kind of brought that up. But then you hear about maybe Bitcoin or gold and other things like that. And I'm always like, stocks, talk about the equities, talk about investing in companies, because guess what companies can do in inflationary periods? They can raise their prices because that's what happens. You get scarcity. They're allowed to increase prices. You can participate in that. So let's make sure you understand the details. So a lot of you are like, that is true. I haven't heard a lot about this. Can you backtest this? Can you go back in time and show us what has happened in prior higher inflationary periods? And we had Daniel pull that data. If you go look at the late 70s, early 80s, you can see 1978, inflation was 7.5%. Now, look, you're going to be like, well, why is he starting off with 6.41? But this actually makes my point. When inflation comes on the scene, it is not uncommon to have short-term volatility because it does cause some issues where, companies are trying to figure out, do we pass this on to customers? Do we absorb it and it hurts our profit margins? There is a period of uncertainty, but eventually, once we realize we are in an inflationary period, the company says, you know what? We got to pass it on. And you see the price increases go out there to the customers. So let's continue this exercise. 1979, inflation was unbelievably 11.35%. The S&P 500 made 18.69%. 1980, 13.5% for inflation. The market made 32.76. 1981, 10.32% inflation. Market lost 5%.
Yep.
But look, when you're making 18 and you're making 33, you can give back 5 because there is volatility. You don't get this all free. If it was free and easy, we'd all do it. 1982, inflation starting to moderate a little bit, 6.2%. Market still made 21%. And then I closed it out with 1983 on purpose because you can see inflation is back to kind of historical norms, 3.2. Here's the good news when you do equity investing. You got to believe if you're coming through a high inflationary period when, prices are going up, everybody's freaking out about it. When you actually get your first indicators that inflation's been tamed and we're back to historical norms, what do you think people are thinking? They're like, hot diggity dog,
best of both worlds.
because now we don't have to worry about this corrosive part where our purchasing power is going away. People are going to celebrate because guess what? Companies now, in addition, just raising their prices so they can keep it, they actually get to keep more of that profit margin because it's not like prices fall all the way back to where they were. So you see the markets actually celebrated with a 23% rate of return in 1983. Guys, investing in equities, investing in the ever-expanding economy is actually a great inflation hedge.
Now, we are not suggesting that we are anticipating 11.4, 13.5, or 10% plus inflation. Don't mishear us on that. But it is interesting to look back at the late 70s when inflation was rampant to see what the market was doing. And so the question that you may be asked is, okay, well, stocks are good during an inflationary environment, and maybe it was good in the 70s, but does that mean I just do the stock thing right now and then get away from that and stop doing that? No, not at all. If we look at the S&P 500 versus inflation from 1980, right there at the end of that high inflationary environment in the 70s, all the way through 2021, you can see that inflation has averaged about 3.3% per year. Again, right in line with that 100-plus year average. But the S&P 500 has actually made 11.6% annually. So the purchasing power of your army of dollar bills actually grew through time. Not only did it keep up with inflation, it smoked inflation over this past 41-year period.
Yeah, so that leads to, because we just gave you a lot of ammunition on why equity investing can actually be good.
Sure.
Now, look, there could be volatility, but long term, in the short term, there's volatility. Long term, this thing is a wealth building process. But a lot of you are probably right now going, what about real estate, guys? Let's talk about some real estate. So once again, I think it's interesting. We know owning a home can be valuable and be a hedge to inflation, but that's tough right now. And I want to put a kind of a pin to pause, and we'll come back to this later because that's going to be in the decision-making part of the show. I do want to talk about some of the struggles I know even our own employees are having in this crazy inflationary period.
One question I have for you, Brian, because you and I have talked about this a lot before. We just said it sort of as a given. Owning a home can be a great way to protect against inflation. A lot of our audience has probably never owned a home, never experienced that, never done that. I remember you telling me the first time that you noticed owning a home was a good inflation hedge. You were talking about your parents, right? And how much I can't remember if it was their first house or their first mortgage, and what they had versus when you went off to the University of Georgia. Do you know what I'm talking about?
Yeah, I mean, it was one of those things where my parents, we built the house that, kind of I was raised in. in 1978. So I'm sure they signed the contract in 1977, but that we moved into it in 1978. And I'll never forget, my parents paid $60,000 for that house. So when you hear Warren Buffett
For
talk
a family
about,
of four,
yeah, because Warren
not-
Buffett, you hear the story all the time. He bought his house that he lives in for like $35,000 in like the 60s. Well, I have the similar stories. My parents' house was, late 70s was $60,000. Fast forward, I go to college in the early 90s, graduate college in the mid 90s, get my first apartment in Atlanta, and I was one of three guys living together. My part of the rent was $450 a month. Now, look, that sounds cheap right now. A lot of you guys are watching this going, my portion's $1,200 a month.
Inflation.
But that's, once again, a point of inflation because I'm getting older at this point. But my $450, which was a third of the $1,250 of the mortgage because I had a bigger bedroom, was my parents' mortgage was like $300. And I was like, how is it that my parents can have a house now that's worth $250,000? I'm living in this little apartment and their payment is a lot. That's what inflation does. So a lot of you guys, I know, but here's the thing. I know Team Crash, some of our employees that are trying to get on the real estate train. It's not a fair time right now, and we'll come to those points. So I'm telling you, you don't have to buy a house to also have inflation hedges. You can buy real estate mutual funds, real estate ETFs. You can buy REITs. There's all kind of ways you can invest. Even if it's $100 at a time, you can also be a real estate investor.
And I think one of the great things about that is it gives you the exposure to real estate and gives you the ability to invest in real estate without having to do something like go out and buy rental properties or go out and buy physical land. Again, those are things that you can do, and those are things that can be an inflation hedge, but there's some barriers to entry in terms of cost of capital. In our opinion, rental property is not a passive activity. It's a very active activity. But if you were someone out there and you just said, you know what, I like this idea of real estate. How has it done against inflation? How has it performed? Well, if you look at the FTSE Nareit All REIT Index, so this is just a global index of real estate investment trust investments. Since 1980, inflation has averaged, again, that 3.3% or so. And real estate has made about 10.3% annually. Again, not only did it keep up with inflation, but it smoked inflation. It did much better than inflation. So certainly real estate as an investment was a great hedge and a great way to combat an inflationary environment.
Yeah, I think based upon just some of the data we looked at, real estate does do well during inflationary periods. Equity investing, meaning in the financial markets, does really well.